Hello again, everyone. Jeff Dorman, Chief Investment Officer at ARCA. Another edition here of That's Our Two Satoshis Live. Again, we write a weekly blog every week on Mondays called That's Our Two Satoshis. It's on our website at ar.ca. And we talk about the digital assets market and what's going on. We actually missed last week because of the holidays, so we might actually talk about our last two that we wrote. But this week really was a short one. The title of it was Two Hands Tied Behind Our Back. And the thought process is simply, digital asset investors and participants and developers and everyone in this ecosystem, we're obviously very passionate about what we think we're building and what the future of finance and really e-commerce and everything in between looks like as a result of blockchain. But there's no question that it is, getting difficult given the amount of negative media coverage out there and given the regulatory tape bombs that just keep coming with no action behind it. It's funny because post the Luna fallout, everyone in the market is now just waiting for the next shoe to drop, right? Is it going to be another stablecoin depeg and like Tether? Is it going to be a lender implosion? Everyone pointing the fingers at Celsius despite no data to support it. Are there going to be more fun wind downs, et cetera? So essentially, it's interesting, right? We're effectively looking for something to come out of left field. Even though in my opinion, I think the worst is over, but like the market is looking for something to come out of left field. And truthfully, that would be, more desirable at this point than what we're actually getting, which is instead of coming out of left field, it's actually just the umpire calling timeout, making a huge spectacle on the pitcher's mound, spitting on all the players and drawing attention to themselves. And what I mean by that is let's just look at some of the data just from last week alone. We recently got a report from the Federal Reserve. That was actually a pretty well done report. It's the link to it is in our blog. Talking about that 12% of U.S. adults have held or utilized digital assets in 2021. That's a big number, right? That's the kind of adoption that you would expect someone like the U.S. to say, okay, we have something here, right? People want to use this. This is clearly solving some problems. Let's foster the growth further. But instead, we get the exact opposite, right? Just last week alone, you had the New York AG, the New York Attorney General, issuing a investor alert, basically warning about the dangers of digital assets. You had the SEC go on its YouTube channel and basically flat out mock anybody who invested in digital assets or meme stocks. You also, you have forms that are now being required to fill out if you want to do a Reg A offering in digital assets that if you actually look at the form, and again, we link to the form on our blog, it just makes no sense. I mean, even if you wanted to do things, quote unquote, the right way in the SEC's eyes, you physically can't because they've made no adaptations at all to what the new digital asset regime really looks like. So, it's a little frustrating. It does feel like sometimes we're trying to build an industry with two hands tied behind our back. I hope some of this starts to change in the near future. I think there's a lot of good regulators out there. There's a lot of good politicians out there who are recognizing that this is important technology, and we have to figure out how to regulate it responsibly while also not stifling the growth. But, certainly last week didn't feel like that was the case. But I want to go back a week earlier to what we wrote on May 31st, which was, in my opinion, two important topics. So the first of all was the decoupling, right? We've been talking about how digital assets have been trading in line with equities now for, really most of the year and even dating back towards the end of last year. We've all been waiting for a decoupling, right? When are digital assets going to be uncorrelated again? And we actually have started to see it a little bit in the last couple of weeks. Not necessarily in a good way, right? Equities have now bounced almost 10% off the lows on May 20th. The S&P was down 20% for the year heading into bear market territory and immediately bounced off that. Now is only down 12% for the year. And the NASDAQ, same thing, down 30% and back up to only down 22%. But we really haven't gotten any sort of a bounce at all in digital assets. So on the one hand, kind of a bummer, digital asset prices not going higher. On the other hand, this is actually what you'd expect to happen with a asset class that has historically been completely uncorrelated, is that these short-term correlations go away and eventually they start to trade for different reasons. So, on the one hand, not great to see digital assets underperforming. On the other hand, pretty good sign in our opinion, longer term, that we're starting to see a little bit of a breakdown in that correlation. But more importantly, I want to talk about two things. I want to talk about first, sort of what this new Luna restructuring looks like. And then also, why are other companies and projects not issuing a token? So I'll start with the first one. For those who don't know, Terra Luna basically just resurrected itself. You could even say they just executed one of the fastest bankruptcy restructurings in history. So only 2 weeks after the epic collapse where 20 billion of UST was wiped out, 40 billion of Luna was wiped out, Terra 2.0 is already functioning and already has a token that's trading. I think as of right now, it has about a $5 billion market cap. So on the one hand, this is kind of crazy, right? You just wiped out 60 billion. The blockchain clearly failed in terms of its core usage of the UST stablecoin. But at the same time, the blockchain itself works fine. There's no reason to ever shut it down, and you just need a new token to secure the network. So it's really interesting, right? Because I like to make a lot of traditional finance analogies. I like to think about this in the way that you would think about a traditional bankruptcy. So, let's talk about what would happen in a bankruptcy, especially here in the US, right? You would have a waterfall of some sort. You would have different committees. You would have your equity committee. You'd have your unsecured creditor committee. You'd have your secured creditor committee. You'd have your, employees and unions and vendors having a committee. And everybody would go through the US bankruptcy process, especially in a Chapter 11, and they would basically argue for who is supposed to get the most of the value of the reorganized business, right? So when a company, let's say like Hertz, for example, Hertz, the rental car company, when a company goes bankrupt, the company doesn't stop operating. They simply wipe out their balance sheet and their capital structure, and they start anew with usually less debt and a more viable business plan. That can often take, anywhere from 6 to 18 months to go through the bankruptcy court process and figure out all these claims. But you know exactly who, in theory, should get most of the value, right? Usually it's from the top down, your vendors, your other high claims on the business, and then you have your secured creditors, then you have your unsecured, then you have your equity. Well, in the case of Luna, it's really weird though, right? One, instead of taking 6 to 18 months, this only took 2 weeks. And two, even though UST should have been basically the debt or the creditor in this equation, and Luna holders should have been the equity, it really made no sense to treat it that way, because we all know that UST is dead. UST is not coming back. The algorithmic stablecoin within the Terra Luna blockchain is not coming back. But the Luna blockchain itself still exists. So there's really no benefit to have given all of the UST debt holders their money back at the expense of Luna quote unquote equity holders. What you really want to do is give a lot of the value to the Luna holders, because those are the ones who are ultimately going to build on this network and keep it going as a going concern. So I thought about it, like, is this better or worse? I'm not sure it's either. I think in some ways it's better because it was faster. You got to a result much faster. You didn't have to go through 18 months of very costly bankruptcy court proceedings. On the other hand, there's certainly going to be an argument that UST holders should have made out better than they did. I think UST holders basically got about 25% of the new chain, whereas Luna holders got about 45%, and there was another 30% held back for the community. We have that table in our blog from last week if you want to look at it. But I think there's something really interesting here from a valuation standpoint, and that is, if the new Luna is worth anywhere close to this $5 billion market cap that it's trading at right now, we basically just answered a really important question, which is, what is the floor value of something that cannot die? And what I mean by cannot die is, typically in a normal company, if you run out of cash or you have high interest expense relative to your cash flows, you could go bankrupt, right? You could run out of money and say, I can no longer pay my bills. I have to file for bankruptcy. But a lot of these blockchains and other companies and projects that are building in the blockchain world, they don't have really any expenses, right? They have no offices. They have no physical goods. These are companies with incredibly low cost bases, and effectively you can't really kill them. They never go away. So in the Luna case, the old Luna was trading at a $40 billion market cap based on the perceived tokenomics around the growth of UST. But the blockchain itself, even though it was only really being used for the case of the stablecoin and other things built on the USD stablecoin, the blockchain itself functions. It works fine. You can build many apps on it. It's a smart contract platform, just like anything else, like an Ethereum or a Cardano or Solana or anything else out there. So if you're telling me right now that a resurrected blockchain that already has a really deep community, it already has people who care about it, and already has apps and stuff that are developed on it, has a minimum value of $5 billion coming out of a quote unquote bankruptcy restructuring, doesn't that just raise the valuation of every other layer one blockchain? Doesn't that just basically mean that the minimum value for any functioning layer one blockchain should be $5 billion? It could be. And if you want to rationalize why that might be the case, think about Black-Scholes. For anyone who's ever traded options before, there's a formula called Black-Scholes model, which tells you what the value of an option should be. And there's 5 components of the Black-Scholes model, 3 of which are time, volatility, and interest rates. time, meaning the longer time period you have, the more expensive an option is going to be, because if you have more time to expiry, it should have more value. Well, something like a layer one blockchain that can never go bankrupt, they have infinite time. That should be priced really high as an option. Volatility, that's the second component. Well, we all know that in digital assets, the volatility is super high. So that's another reason for it to have high option value. And the third is interest rates. Whenever you have low interest rates, you have a higher Black-Scholes model output in terms of the price of an option. So if you priced every single layer one blockchain, from Ethereum, which obviously has real economic activity on it, to a Cardano and an EOS that has absolutely nothing going for it, the reality is you could now make a case that Luna just proved that the minimum value for these is $5 billion. And if that's the case, well, there's a lot of value to be had in owning protocols that just can't die. So I think that's an interesting discussion. And I really encourage people to read that and hit me up on Twitter and ask questions. Tell me what you think about that analysis. But there's a chance, and I really believe this is true, that we're going to come out of this post Luna 2.0 restructuring realizing that blockchains are worth a lot more than the market is giving them credit for, even if there isn't a whole hell of a lot built on it. And finally, I think the last thing we discussed, which again I would encourage people to go to our blog and read it, was the more we learn about digital assets and what their use cases are besides just decentralized currencies and decentralized protocols, we realize there really have been a lot of success stories of companies, real companies with real balance sheets, real cap structures, real board of directors and CEOs and management teams, that a lot of companies have used tokens in pretty innovative ways, right? Binance being probably the most important with their BNB coin, but also others like Bitfinex's Leo token and FTX's FTT token, and even Chili's CHZ token. These are all companies that have real, again, equity and real management teams and real boards that also have found a way to issue a token in their capital structure. And those, for real reasons, are largely some of the best performing tokens in the market. And why is that? Because these are companies that do have real cash flows and revenues, and they use those cash flows and revenues to pay down the tokens, either in the form of buybacks and burns, or in some cases, even actual dividends to token holders. And you wonder, well, why have these companies done so well? Well, they've done well because they have figured out stakeholder alignment. They're saying, if you're a customer of our company, if you're a trader on BNB or on Binance or FTX, or if you're a sports fan using the Chili's blockchain, that if you're a member of this community, if you're a customer of this business, we want to basically encourage you to have financial upside in the success of our business. That's why these tokens are so powerful, right? They're part financial upside through the revenues and profits of a business, but they're also part membership reward cards or loyalty cards as being a frequent customer or user of the product. Well, why isn't every company in the world doing this? And I put in the example in our blog, I put the example of Netflix and Peloton. Like, why are Netflix and Peloton not issuing a token right now? And the obvious answer is, for regulatory reasons, no US company knows how to do this. And let's get past that for the time being. But intuitively, Netflix and Peloton should absolutely issue a token today. So let's take Netflix, for example. Right, Netflix is struggling. Their stock is down, I believe, 71% from its all-time highs. They're losing subscribers. They have no real moat, as companies like Disney and Amazon and Hulu are starting to get better content libraries, right? But Netflix has a solution to this, right? They have 220 million subscribers, but 80% of their shareholders are institutional investors, which means there's a massive disconnect between the people who use Netflix and the people who own Netflix. Well, you can change that with a token. Let's say they issued a token that 30% of the token was reserved by Netflix for future issuance, and 10% was just given away to Netflix users, and 40% was sold to Netflix customers who could then use it as a way to pay for their subscription. And then you think about all the different financial things that they could do, just like Binance did, just like FTX did, where they could have 20% of all of their revenues or profits being dividended back to Netflix token holders. You could also have a discount if you pay for your subscription, your monthly subscription fee with Netflix using the Netflix token. They could also incentivize longer-term customer payment plans by saying, you can get even a heavier discount if you pay for a 2-year plan or a 4-year plan. They could also say, if you own the Netflix token, you get more exclusive rights to new content. Maybe there's a season finale that you get access to 3 days before someone else does because you own the token. They could even solve their subscription sharing problem, right? Everyone's so freaked out about how Netflix used to let anybody share passwords, and now they don't let you do it anymore. Well, guess what? The blockchain itself is a pretty verifiable way to do that. There's all these different ways that you could design a Netflix token that solves all of their customer retention problems and their revenue shortfall problems. And Peloton's the same thing. I won't go into the same detail. You can read the blog and see it, but the same thing, right? Peloton has this massive customer base. None of their customers own the stock. They don't care about the success of Peloton. They're just riding the bike or running on the treadmill. But you could put a token out there that actually does make their customers care about the success of Peloton. This is where we're headed, and I really believe we're heading faster than people think. So if anybody's watching this who has who works in investment banking or has friends or family working in investment banking, do what I do. Talk to them every day. Say, hey, why are you not pitching this? Why are you still jamming the same debt and equity deals down your customers' throats instead of being innovative by helping these companies issue a token? Because I guarantee there will be a Netflix token one day. There will be a Peloton token. There will be a Starbucks token, a Delta token, you name it. And we're starting to see why, right? In good times, people don't care about innovative ideas. When Peloton was, stock was going up 200% a year, or when Netflix's stock was going up 200% a year, nobody wanted to be innovative. Well, right now your stocks are getting crushed and your customers are leaving. So come up with an innovative solution, and feel free to reach out to me if anyone's listening from Netflix and Peloton, and I'll help you design the token myself. So that's it. Hope everybody enjoyed this week. So that's our 2 Satoshis Live. Again, this was 2 different blogs, one from last week on May 31st, one from yesterday, or rather today on June 6th. All of them are available on our blog, ar.ca, and you can reach me on Twitter at jdorman81. Thanks, everybody.